Hello and welcome to Investment Insight, your clear take on the markets. Let's get started.
It's great to be here.
Today, we are grounding ourselves in the present moment, January 16th, 2026. And, well, if you've looked at a newspaper, a trading terminal, even just your phone this morning, you know exactly why we're here.
Oh, yeah, it's the only story on the planet today.
It really is. We are looking at a massive new trade agreement between the United States and Taiwan. And when I say massive, I mean the kind of number that makes you blink twice. We're talking about a deal valued at $500 billion.
It's a staggering figure. I mean, to put that in perspective for everyone, $500 billion is roughly the entire GDP of a country like Austria
Wow.
or Thailand.
Wow.
And the U.S. and Taiwan just decided to move that much capital around on the global chessboard in a single morning.
That's mind-boggling. And it affects everything. We aren't just talking abstract economics here. This is about the phone in your pocket, the guidance system in your car,
The toaster in your kitchen.
the toaster in your kitchen, and honestly, national security. So the headline is, the U.S. is lowering tariffs. But in exchange, Taiwan is making a historic commitment to move a huge chunk of its semiconductor industry, the chip industry, onto American soil.
Right. And our mission for this deep dive is to look past that headline.
Yeah.
Because on the surface, it looks like a boring trade treaty. Clause A, Section B. But if you look closer at the data we've analyzed from Reuters and AP News, this is actually a blueprint.
A blueprint for what?
It's a blueprint for how the United States plans to de-risk its entire economy.
De-risking. That has to be the buzzword of the decade. Everyone's trying to de-risk everything. But let's unpack this because there are a lot of moving parts. Let's start with the sticker price. The headline everyone is seeing is about tariffs, taxes on imports. What exactly are we looking at here?
So according to the data available, the U.S. has officially agreed to drop the broad tariff rate on Taiwanese imports from 20% down to 15%.
Okay, let's pause there for a second. A 5% cut. I mean, in the grand scheme of things, is that really a game changer? If I get a 5% coupon at the grocery store, I'm happy, but I'm not throwing a parade, you know?
It sounds small, I agree. But in international trade, context is everything. You have to look at who else is in that 15% bracket.
Okay.
By dropping to 15%, the U.S. is effectively upgrading Taiwan's status. They're moving them out of the general trading partner bucket and placing them on the same playing field as major treaty allies, like Japan and South Korea.
I see. So it's not just about the money saved, it's about the status. It's a VIP pass.
Exactly. It's a massive diplomatic signal. It's the U.S. saying you are now in the inner circle. However, and this is the part that makes this deal so unique, unlike Japan or South Korea, Taiwan didn't get this VIP pass just for being a friend.
Right, because usually a tax cut is just a thank you. But my reading of the report suggests there are some serious strings attached to this specific pass.
Massive strings. And they're made of silicon. This is where it gets really interesting. This isn't a blanket tax cut. According to the Reuters analysis, specifically for semiconductors, this is what trade officials are calling an investment-linked exception.
Investment-linked exception. That sounds like lawyers speak for, we are watching you.
It's incredibly conditional. Think of it like a loyalty program at a really exclusive, high-end department store.
Okay.
You don't get the discount just for walking in the door. You get the discount because you sign a contract promising to build your house in the store's parking lot.
Wait, literally move into the parking lot?
Metaphorically, yes. The United States is saying to Taiwan, we will give you these lower tariffs or even zero tariffs on your chips, but only if you expand your production factories inside the borders of the United States.
So it's a conditional reward.
Exactly. You have to physically move your assets here to get the benefit.
So it's not free money, it's a pay-to-play model. You have to pour concrete in Arizona or Texas if you want to sell your chips tax-free?
Precisely.
That brings us to the other side of this equation. The price tag. We mentioned $500 billion earlier. That is $500 billion. Now, I have to ask, is that all cash sitting in a briefcase? Because usually when I see government numbers that big, it's projected value over 50 years or something vague.
That is a great question, because usually you would be right. But based on the breakdown in the AP News reports, this looks like real capital. And breaking it down is crucial for understanding the strategy here. That $500 billion package is split right down the middle into two very different buckets.
Okay, walk me through the first bucket.
The first $250 billion is what we call direct investment or hard CapEx.
CapEx.
Right, capital expenditure. This is money spent on the physical stuff. Concrete, Steel, clean rooms, and those incredibly expensive lithography machines that print the chips.
And this includes the money from TSMC, the Taiwan semiconductor manufacturing company that we've been hearing about for years, right?
Okay. Correct. TSMC had already announced about $100 billion in investment back in 2025. This new deal expands on that significantly. This is the cash required to build the actual factories, the fabs, in places like Arizona.
Okay, so that's the brick and mortar, but you said there was a second bucket.
Yes, and frankly, this is the fascinating part. The other $250 billion isn't for building the big factories directly. It's for credit guarantees.
Credit guarantees. That sounds a bit dry, like banking jargon. Why does that matter to me or the average investor listening?
It matters because of how the chip industry actually works. Let's use an analogy. Imagine TSMC is a world-famous chef. Let's say a Michelin star chef.
Okay.
The U.S. convinced this chef to move to Arizona to open a massive flagship restaurant. That's the first $250 billion. But a chef can't cook without ingredients.
Right. They need the flour, the vegetables, someone to fix the oven, someone to clean the uniforms.
Exactly. In the chip world, we call this the cluster. You need specialized chemical suppliers. You need companies that make the testing equipment. You need packaging facilities that put the chip into the plastic casing.
And I'm guessing these companies are much smaller than the giant chip makers.
Much smaller. And that is the problem. TSMC has billions in the bank. They could afford the risk of moving to America. But Mom and Pop Chemical Co. from Taiwan, they can't afford to build a new factory in the U.S. It's too expensive, and banks won't lend them the money.
It's too risky for them.
Way too risky. Yeah, I see where you're going. If the small guys can't move, the big guy can't cook.
Precisely. Without the cluster, the factory fails. So the U.S. government is stepping in as a cosigner. That $250 billion in credit guarantees is the U.S. telling the banks, lend money to these smaller Taiwanese companies so they can move to Arizona too. If they go bust, Uncle Sam will cover the loss.
So they aren't just importing the star player, they're trying to buy the whole team.
The U.S. Commerce Secretary was very clear about this in the reports. The goal is cluster migration. They want to bring 40% of Taiwan's entire chip supply chain and production to the U.S. They want the whole neighborhood to move.
That is a massive undertaking, moving 40% of an industry halfway across the world. I mean, that sounds incredibly expensive and risky for the companies involved. So put yourself in the shoes of a CEO in Taiwan. Why would you agree to this? A 5% tariff cut is nice, but is it enough to uproot your entire company?
You are right to be skeptical. The tariff cut alone probably wouldn't be enough motivation. But the deal includes a mechanism that I think is one of the most clever pieces of policy engineering we have seen in years. It's called the 2.5x rule.
The 2.5x rule. It sounds like a multiplier in a video game. What does the data say about this?
It's officially called an investment-linked import incentive. Here's the problem with building a factory. It takes a long time, usually 3 to 4 years.
Right. We call that the valley of death in business. You're spending money on construction, but you're selling zero product from that factory.
Exactly. Your cash flow gets crushed. So the U.S. offer is this. While you are building that factory in the U.S., we will let you import chips from your existing factories in Taiwan duty-free, no taxes at all.
Okay.
But there is a limit. You can import up to 2.5 times the projected capacity of the new factory you were building.
Whoa. Wait, let me make sure I understand the math here.
Yeah.
If I promise to build a factory in Arizona that makes 100 chips a year, the U.S. lets me sell 250 chips tax-free right now while I'm building it.
Correct. It acts as a bridge. The profits from those tax-free imports act as a massive cash injection to help fund the expensive construction of the new U.S. factory.
That is incredibly clever. It's like they're financing the move with the tax savings.
And it forces de-risking. It makes it financially irresponsible not to move. If your competitor takes the deal and gets the tax break and you don't, you can't compete on price, you're dead in the water.
So everyone has to jump on the boat?
It's a golden handcuff. Take this free money, but you have to use it to cement yourself into the U.S. economy. But I have to play devil's advocate here. We are spending $500 billion. We are moving the cluster. Does this mean the U.S. is finally going to have the absolute best cutting-edge technology? Are we going to be making the chips for the iPhone 20 right here in Phoenix?
That is the billion-dollar question. And the answer, according to the experts and the data we reviewed, is not quite.
Really? After $500 billion, that feels like a letdown.
We have to understand the concept of the transfer gap. Sources indicate that while production volume is moving, the leading edge, the absolute newest bleeding edge research and development, is likely going to stay in Taiwan for now.
Why? If you're moving the factory and the supply chain, why not move the R&D labs too?
Because innovation isn't just a blueprint you can email. The most advanced chips require a tight loop between the PhD scientists, the engineers running the machines, and the supply chain. It's a delicate ecosystem of tacit knowledge that has been optimized in Taiwan for 30 years. You can't just airlift that culture and operational instinct overnight.
So it's like we're getting the bottling plant for Coca-Cola, but the secret formula is staying in the vault in Atlanta, or in this case, Taipei.
That is a brilliant analogy, yes.
Yeah.
The U.S. gets volume, we get security, we get the ability to make a lot of chips, which is crucial for cars and missiles and basic electronics. But Taiwan keeps the crown jewels of innovation at home.
It's a realistic compromise.
It is.
Yeah.
Taiwan need to keep something for themselves to remain indispensable. They call it their silicon shield.
That makes sense. They don't want to make themselves obsolete. Now, we have to talk about the elephant in the room. Or rather, the elephant in the White House.
Yeah.
It's 2026. Donald Trump is president. And we know his administration loves tariffs. He views them as a primary tool for negotiation. But looking at the report from AP News, there's a legal risk here, isn't there? Something about the Supreme Court.
This is critical. The entire deal, the VIP status, the 15% rate, is built on the president's power to adjust tariffs. But right now, the U.S. Supreme Court is expected to rule very soon on a case that defines the scope of the president's tariff powers.
So let's play out the worst-case scenario. If the Supreme Court rules that the president can't just change tariffs whenever he wants without Congress,
Then this whole deal stands on shaky ground. If the court limits that power, the mechanism of "we will cut your taxes if you invest" might become unconstitutional, or at least legally difficult to enforce.
wow. So we have a $500 billion deal resting on a pending court case. That adds a serious layer of anxiety to all this. Imagine being a Taiwanese CEO pouring concrete in Arizona, wondering if your tax break is going to be illegal next week.
It creates a lot of uncertainty. Corporations hate uncertainty. They are committing billions of dollars based on a rule that could theoretically be overturned. It's like building a skyscraper on land where the ownership deed is still being disputed in court.
Okay, let's pivot. We've got listeners who are thinking, this is all fascinating, but what does it mean for my portfolio? If I'm a normal person, a beginner investor, what do I look at? The obvious move seems to be buy TSMC.
Well, that is the obvious move, but looking at the reports, I would suggest a shift in perspective. Don't just look at the chef. Look at the companies selling the ovens and the flour.
Back to the cluster, you mean the suppliers.
Exactly. Look at the equipment makers, companies like ASML, Lam Research, Applied Materials. But also look deeper. The data mentions smaller chemical companies and material science companies that are moving to Arizona to support the big factories.
Because they have guaranteed demand, right? If the factory's being built, they need the chemicals.
Precisely. And remember, they are getting those credit guarantees we talked about. They are effectively being subsidized by the U.S. government to grow. So the big winners might not just be the big name on the building, but the companies that sell the pipes and the wiring and the specialized gases that go into the building.
It's the classic picks and shovels strategy.
That's it. It's a great tip. Look for the ecosystem, not just the headline act. But what about the risks? We talk about the Supreme Court. What about Taiwan? Is this all good news for them?
Not necessarily. There is a heavy political cost. The sources highlight a fear of hollowing out.
Hollowing out, like emptying out their own economy.
Yes. Think about it. If you send your best engineers, your best managers, and your most advanced manufacturing capacity to America, what is left back home? There's significant pushback within Taiwan. The people are worried they are losing their national advantage and their economic engine.
And remember, this deal still needs political approval. It's not a done deal until the ink is dry and the parliaments vote.
Exactly. There could be protests in Taipei, there could be political gridlock that slows this down, and then there is the biggest geopolitical risk of all, the China factor.
Right. We can't talk about Taiwan without talking about Beijing.
The sources are very clear on this. This deal cements the tie between the U.S. and Taiwan. It integrates their economies. That inevitably angers Beijing.
And for an investor, that anger isn't just noise on the news, it's financial risk.
It is what we call a risk premium. If you hold Taiwanese assets or even U.S. tech stocks that are heavily exposed to this deal, you have to account for the fact that geopolitical tension could spike at any moment. This deal might actually increase tensions in the short term, even if it creates security in the long term.
So if I'm buying these stocks, I need to understand that their price might swing wildly based on what a diplomat says in a press conference, not just on how many chips they sell.
Exactly. You are buying the volatility along with the growth.
This has been an incredible breakdown. Let's try to summarize this for everyone listening, just to make sure we have the big picture locked in. We are looking at January 2026, a $500 billion deal.
Right.
The U.S. cuts tariffs to 15%, treating Taiwan like a VIP ally. In exchange, Taiwan moves 40% of its chip supply chain to the U.S.
Correct. That's the core trade.
This move is funded by $250 billion in direct investment for factories and another $250 billion in credit guarantees to help the smaller suppliers, the cluster move too.
Yes. The chef and the ingredients.
And they're incentivizing it with the 2.5x rule, allowing duty-free imports right now to fund the factories of tomorrow. It's a bridge to get them across the ocean.
That is the perfect summary.
But we have risks. The transfer gap means the absolute best tech likely stays in Taiwan. The Supreme Court could strike down the legal basis of the tariffs, and the geopolitical tension with China creates a permanent risk premium on these stocks.
You nailed it. It is a high-stakes game with massive potential rewards and massive risks.
So here is where I want to leave it. We've looked at the numbers, we've looked at the mechanics, but what is the one thing you want our listeners to walk away thinking about today?
You know, we often think about economics as supply and demand, numbers on a spreadsheet. But this deal asks a much deeper question. The question isn't just about the 15% tariff rate. It's about whether the U.S. can successfully transplant an entire industrial ecosystem before the political or legal winds shift.
Can you actually buy a supply chain?
Exactly. Can you buy a culture of innovation? Can you write a check and move 30 years of engineering history to a desert in Arizona? We have never seen an industrial migration of this scale attempted this quickly. If it works, it secures the U.S. economy for 50 years. If it fails, well, that is a $500 billion lesson.
A $500 billion gamble on whether money can buy culture.
Whoosh.
And we will be watching every roll of the dice. Thank you so much for breaking this down with us.
My pleasure.
And thank you for listening. We hope this gave you a clear view of one of the biggest trades of the decade.
Don't forget to subscribe and hit that like button. We'll see you in the next deep dive.